Good morning, everybody. Happy Thursday. My name is Nima Farshchi, and I'm the Executive Director of Alumni and Corporate Engagement at the Smith School of Business at the University of Maryland, as well as our Director of our Center for Social Value Creation at the Smith School. We are very excited to kick off this risk leadership event for everyone in our webinar series. I would love to pass it over to Robert Iamazzo, the Managing Partner of CIBA International. Rob, I'll let you take it away.
Thank you, Nima. Good morning, good afternoon, good evening to our attendees. We know that we are far flung. Would like to just welcome everyone and thank both Cliff Rossi and Ryan Zanin, our participants, and Cliff being our, of course, host and moderator. Risk Leader, we're excited to kick off this year's Risk Leadership Series webinar with this discussion with Ryan, who has served on the board at Fannie Mae. Prior to that, held senior risk roles as CRO at GE, Deutsche Bank, and currently is the group CRO at Fannie Mae. So really, thank you, Ryan, in advance to being able to provide some insights to us all on board risk committee, leadership, all of that good stuff. And with that, I'll turn that over to you, Cliff. And once again, we appreciate the collaboration and thank you.
Thank you, Rob, and for all your support and sponsorship of this series over the years. So I look forward to many more of these going forward. For all of you out there, you may know me. If you don't, I am Cliff Rossi. I am a professor of the practice and an executive in residence at the Smith Business School at the University of Maryland. And again, we're running these risk leadership webinar series as a way to kind of promote the various topical issues that are going on in risk management these days. Today's webinar is a very interesting one in my mind. It gets to the heart of risk governance at the top of the house by focusing on what board risk committees are really kind of looking at these days. Not surprisingly, there's any number of financial and non-financial risks that are lurking around the corner out there with a plethora of market and geopolitical and social and environmental catalysts ready to ignite one or more of these risks. So as Rob said today, helping us understand these issues, we're happy to have Ryan Zanin, the Chief Risk Officer at Fannie Mae and soon to be CRO at Westpac, it was announced. And so Ryan, thank you very much for joining the webinar today and congratulations on your new appointment at Westpac. I want to jump right on into things here. And the first question I'm going to ask you is probably just kind of warm things up, if you will. And in light of your experience, having been on both sides of the table, so to speak, what are board members at financial services companies in general most concerned about these days from a risk management standpoint?
Great. Cliff, thanks for having me. And Robert, thanks for arranging all this, and certainly welcome a dialogue and questions going forward. The way I think about it, Cliff, is there are a few things that are always on the minds of board members and folks who care to oversee financial services organizations. And I think about, the few things that are out there on a constant basis, which I call kind of the table stake items. And that's around safety and soundness, capital and liquidity, meeting customer and regulatory expectations. So those are never far from the top of the pile in terms of what is on people's mind. And they're always part of kind of our regular risk framework because we can't forget those things. We have to stay vigilant about all of those issues. But for the most part, it's an expectation that we're always on top of our game on those things. And sporadically, one of those issues may come up and be kind of a focus or hot topic for us that we dive a little bit deeper into. But then there are kind of those roving topics that from time to time gain more prominence and occupy more of our interest. And I would say that, obviously starting in March of 2020, COVID, it was, all COVID all the time and everything that was expected there. And we're starting to see all those issues retreat into the background a little bit. I think with the exception of what the longer term implications are for the way we work, the way we aggregate and come together as a firm, all of those practices, I think there's a big question mark over what the lasting impact of these changes are. But nowadays, I mean, there are a number of unique risks that are coming to the forefront. The first, foremost, I think, which is emerging, is the fact that macroeconomic environment appears to be changing. We're in a little bit of a different world than we have been for a long time. Interest rates are on the rise, and that has a significant set of implications for folks. The most interesting, I think, of which is the fact that we've gone at least a generation without having an environment where certainly the current management of large financial institutions have ever managed a financial institution through a long-term upward trend in interest rates. So that's just new for folks at the head of the table in most financial services firms. And it'll be great if it is a smooth ride to increased interest rates, but it probably won't be. It'll probably be a bumpy ride, and we'll have some surprises along there. So I think that and all those changes in the macroeconomic environment, rising interest rates, inflation, which we haven't seen again for at least a generation, low levels of unemployment. All those dynamics are starting to change the calculus about how people think about risks. I'd say the other thing that's top of mind for people today is everything to do with technology risks. And those bucket into risks around technology security, but also risks to the business model. If you think about the development of crypto and blockchain starting to become pretty significant numbers in terms of the macro economy. And at some point, it will bleed into the real economy and people's expectations of how we move money around, and frankly, fundamentally, how the banking system is structured in terms of the reliance on deposits and that sort of thing. And I think that there is a potential risk to the business model as technology continues to accelerate. And it will introduce a whole new set of competitors and different ways of doing things on a pretty rapid basis. And so I think technology is a risk that's out there that people are spending more and more time thinking about. And maybe the last bucket of things I think are kind of at the forefront more than they've ever been is what I would call the social landscape. And that social landscape includes things like DEI, diversity, equity, and inclusion, and how we should be thinking about that as a firm, the ESG and all the governance issues surrounding that. And then climate is occupying a lot of people's time as a risk that, while it may actually not be a new risk, it's certainly front and center, particularly, I think, as U.S. regulators and the U.S. as a society catch up with some of the work that the rest of the world has done to shed more light on climate risks, certainly from a financial services standpoint.
There's a lot to chew on with all that, Ryan. So I don't know where even to start with all of this. Is great. The first thing that you started off with was about the change in the macro landscape, and I'd say that I echo this. We had I teach a class in asset liability risk management for graduate students, and we just had our midterm yesterday, and much of it was on interest rate risk measurement. And one of the things, and so many of these risks seem to be sort of like integrated with each other, right? So you talk about technology risk. We could throw data risk in there, if you will, because to your point that while a generation of risk managers haven't actually experienced this, I did back in the SNL days, actually, when I was starting off my career. But at the same time, we don't have, I think, some of the data that we may need going forward to kind of tell us where these things could go, right? We've been in a secular 40-year decline of interest rates, generally speaking, low inflation. And so the models themselves, may be a little tricky to navigate. Would you echo that, or would you kind of, how do you feel about sort of those kind of challenges in managing interest rate risk?
Well, I think that's right. And, I think that we'll find the data, right? The historic data. The question is, can we apply what we know about the historic data onto the current landscape? And the current landscape is just very different. So it's not clear to me that a rising rate environment is going to have the same series of implications and the things that we would have modeled and predicted a number of years ago. Is that how the world's going to unfold, given we have cryptocurrency, we have day trading, we have a much more connected world and a much more fast-moving world than we've ever had before. We also have a tremendous amount of financial assets sitting outside of the global banking system that is regulated, that is easier to monitor. And frankly, we've created a great deal of leverage out there in the non-bank world. And we're going to have to hope that all works out pretty well. We have, post-financial crisis, I think we have significantly de-risked depository institutions around the world by increasing their capital standards, increasing their liquidity standards, and by managing some of the activities that they're permitted to engage in to de-risk them. But those activities still exist. Those pools of capital are still out there, and they still influence macroeconomics. And so to your point, I think our capability to run scenarios and think about how things may play out in the ecosystem, we're going to have to broaden our minds to what those scenarios look like. And we know that all models are going to be wrong in terms of what they predict. But if we calibrate them correctly, they can inform us about the world of the possible. And I think as risk managers, we have to prepare for what some of those possibilities might be.
I totally agree. I usually refer to that as the art and science of risk management, that the analytics can only take us so far. And what turns you in from an analyst to a manager is that ability to kind of override some of those or tune those models with judgment based on the fact that maybe that data and those calibrations aren't exact to the current conditions and whatnot. So I echo that completely. And one of the things it reminds me of too is all these different risks, right, that you mentioned, DEI, climate, even the pandemic, right, that we as a profession have moved over the last 15, 20 years, however you want to, whatever duration you want to say that has been, toward more of a quantitatively oriented, not quite actuarially, but getting closer to that kind of profession, which is great. But it does, these episodic sort of major events does bring us back to the reality that not everything can be measured in exactly the way we would like to. And take DEI, for example, right? This is kind of like where financial risk we have a much better handle on, it seems like, but the non-financial risk, trying to get our arms around those things, you can't rely necessarily on a model-based outcome to kind of get at those things. And yet they're in the forefront of what you're talking to boards about today. Is that any thoughts about that? Or
look, I think that's exactly right. So, I am fortunate to not be either smart enough nor burdened with the ability to be a quant. So that leaves me to have to rely on my imagination about what can go wrong. And after a long career of doing this, I can go to some pretty dark places. But that ability to think about what could go wrong and then to utilize all the tools and techniques and data that's at our disposal in ways it's never been at our disposal before, in terms of computing power, in terms of access to data, to help inform some of that imagining. It seems to me part of our job is to imagine some of the worst things that could happen and then prepare for them, try and create transparency around them and try to understand them. But you're right, I think a lot of the non-financial risks really force us into thinking what could go wrong. And then after that goes wrong, what could go wrong after that? And to sort of create these daisy chains in our mind and think about what we would do. And this is where scenario analysis, I think, is really helpful. Playing through a whole variety of scenarios is incredibly helpful. And you can't be looking for a number necessarily to land on. If you're looking to find out whether you do that work and you end up at 6.8% or 9.4%, you'll get a number out of this kind of work. But really what you get, the value you get, is through imagining the outcomes and then asking yourself, okay, if we don't like these outcomes, what could we do different today to make those outcomes better, directionally better, not necessarily changing the outcome from 6.78 to 7.26. I mean, someone might be smart enough and ambitious enough to make that the goal. For me, the goal is to imagine what could happen, understand what's acceptable as an outcome for us and what's not acceptable. And if it's not acceptable, go back and figure out what do we need to do differently starting today to avoid those outcomes. And, we live in a real world. So there are practical implications and cost benefits that we have to think about. I mean, I can't buttress our institutions from every bad thing that could happen out there, but understanding what they might be and triaging between those risks that we can accept and we can live through, even if they're unpleasant, versus those things that we have to invest heavily in to avoid. I think that's part of the job that we have to provide for institutions.
Absolutely. And one of those risks out there, it's a clear and present one right now, is cyber risk, right? It's just the other day, right, with everything that's going on with Russia and the Ukraine situation, there's been a fair amount of concern about critical infrastructure, particularly that, relating to water supply and the power grid, but also to the financial services sector. And so I guess with that as a backdrop, what concerns do you see today regarding the nature of cyber threats generally at financial services companies?
Okay, I think they are getting ever more complex. So one of the things we know is we have, I think, as financial services and government entities in general, we've invested a tremendous amount to buttress our cyber defenses. And we've had to, because the threat landscape has increased and gotten incredibly more complex, and it never stops. Someone somewhere wakes up every day and tries to do more, do better to penetrate financial services organizations. And inevitably, there are threats looming out there that could be executed at the drop of a hat and simply haven't been, because the bad guys have chosen to hold their power and wait to execute those threats. And in the meantime, I think the financial services organizations and companies in general are doing a great deal to try and stay one step ahead of some of those threats. And for the most part, I think have done a really good job of doing that. We start with a premise that a threat will occur, it will take place. And so while we want to avoid it and prevent these threats to the best we can, we also run our operations assuming that the threat has occurred, has been successful, and then we're in the, well, now what do we do situation. And then now what do we do? What that has to entail is, how do you reduce the spread of the threat, and how do you get back up and running to as close to normal operations as instantaneously as possible? And so, yes, we want to prevent threats, but we also want to be able to recover quickly and recover with the least damage to not only our infrastructure, but the infrastructure of those people we're connected to and who depend on us. One of the things that I think we spend a lot more time on these days is thinking about this notion of a highly connected world. And we have a lot of dependencies, and every financial institution has a lot of dependencies on service providers, other financial institutions, the Fed. And in that interconnected world, you are at risk for whatever service provider or person that you're connected to who provides you with critical operations. Whatever the weakest link is in that entire daisy chain is what's going to bring the system to at least a momentary stop. And so we not only have to think about our own environment, but we have to think and get some assurance about the environment from those people who provide us with critical services. But we are constantly chasing to get better. We're constantly making investments to understand these threat landscapes. And we don't kid ourselves that it's going to ever be a risk-free environment.
On that one, I going back earlier to the comment that it's been a generation or so since we've seen rising interest rates coupled with high inflation. It's almost starting to feel that it's getting to be a half a generation since we've had people that experienced the '08 crisis. And when you think about your point about intersection points or integration points of different risk types, when I think back on that period of time, we certainly attribute most of that crisis to subprime mortgage losses. However, a lot of folks that maybe aren't as deeply steeped into it forget that, we had a liquidity crisis in there. We had operational risk issues that create all sorts of deficiencies in the loan manufacturing process, technology issues. I mean, the regulatory issues. I mean, there were a lot of things going on that have many books have been written about, and so I'm mindful that these risks will manifest themselves in ways that can cascade into each other, right? So if you're not careful, so you have to have eyes on each one of those, but at the same time, you need to also be paying attention at the whole. So I appreciate that, and one of those that seems. You mentioned also at the top of our discussion here is climate risk. And I'd be interested in your take on this because, it seems to me that both from a regulatory standpoint as well as from an institutional standpoint, that the U.S. is a bit behind from where their European counterparts are in the form of kind of building their capabilities and infrastructure to kind of manage this risk. And so can you provide us with a sense of how you're approaching that with Fannie Mae right now in terms of integrating climate risk into your risk management framework and even the taxonomy you may be using there?
Sure. Look, I think it's an important priority for us to get smarter about climate risk and be thoughtful about building a risk framework that creates what I simply call a lens into climate risk and overlay that lens of climate risk across all of our business activities. I think the kind of the order of operations that we're approaching it with is along the idea of let's create knowledge for ourselves about what is the climate risk, how do you estimate it, what's the time frame that you're looking at, what are the potential impacts. And that means we're going to have to do a significant amount of research and modeling and analysis to try and understand what the potential impacts are. The second stage after knowledge, I think, is around transparency. So what do we know, and make sure that stakeholders understand our best understanding of that transparency inside the firm and transparency outside of the firm in terms of what that knowledge is. And then you end up in the sort of area of avoid, accept, and mitigate risk. So we're going to learn a lot about the impact and potential impact over time of climate risk. We'll create some transparency around what that might be. And then we have choices to make. Which of those risks are risks that we want to avoid? Which are those risks that we want to accept? And are there any of those risks that we can mitigate or help mitigate, either for our customers, for ourselves, or through changes in behavior? And then I think finally, and probably the most ambitious piece of this, is how do you change the threat landscape out there? So if climate risk is a threat, if it's a disruptor, I don't know enough risk managers in the world who can, stretch out their arms and tell the world to cool down, right? So, but there are behavioral changes, there are changes in standards, there are expectations, there are choices around financing that ultimately can start to change behavior. And the expectation is with that change in behaviors, you will alter the threat landscape over time. Climate risk is interesting because it's a very long play. And so some of the mitigations, some of the estimations of the risk have some extremely long tails on them. And what we know about anything that we're trying to predict, the further and further we go out into the future, the less and less accurate some of our predictions are going to be. But we'll make clear that we don't have certainty about these outcomes, but we're going to start with a lot more understanding than we have today. And then we're going to have to spend a great deal of time thinking about the impact on consumers, on what risk mitigation might look like in this space. And it's not clear that we have all the answers to this body of work yet. People talk about insurance as being a mitigation to some amount of climate and flood risk, et cetera. And that's true, but it generally tends to be available for only a very short duration. And yet people who are long properties in climate risk areas, they own that duration for a very long time, and the insurance might only be available for a very short period of time. So that disconnect between the risk we own and the mitigation that we might have for it is another piece of the puzzle that we're going to have to sort through over time.
And yeah, absolutely. And what complicates it too is the dynamics of this, right? So, we've had new changes with FEMA's flood insurance pricing, for example, under this new risk rating 2.0 process. And, there's some indications that we're saying, right, that insurance companies are reassessing their hazard policies, their homeowners policies they're provided to borrowers in climate affected areas. And at the same time, we may be starting to see significant changes over the next few years anyway with the rollout of these updated flood insurance policies. So that factors into the discussion you were just saying about the impact on borrowers, and particularly low mod type borrowers at that, and minority areas that are particularly vulnerable. So wrap back again to this climate change or climate risk as being related in some sense. You can kind of make these connection points back to things like ESG, DEI kinds of risks that you can't separate the two, I guess is what I'm saying, right? You have to kind of think of this more holistically.
I think that's right. I mean, that's why the knowledge phase of this work is so incredibly important, because as I said when I was talking about this isn't just about the risk to a financial services company's particular balance sheet. This is a societal risk. And as in many cases, the folks who are least able to afford some of these risks are disproportionately, as it turns out, many times the owners of some of these risks. And the ability to afford escalating insurance costs and all that sort of thing hits some of the most challenged communities disproportionately as well. And there are a lot of historic reasons for that, in terms of not only where homes were built, but the quality of the construction and building involved. And when we see climate events take place, those are the areas in the communities that need the most aid and assistance. But that generally tends to be temporary and doesn't necessarily create a long-term fix to reduce the threat of the next storm, et cetera. And so those are all societal issues that we are going to have to think very, very deeply about. And I think some of the research and some of the knowledge work and some of the transparency that financial services firms are going to create as they get deeper into climate risk, I think that it won't necessarily solve the societal issues, but it will shed light on what some of those issues are. And I think we all hope that we can be part of the solution for these issues going forward.
I want to thank some of the audience has been sending in some questions in the chat room, and I encourage everyone to continue to do that. And I'll pick them up and sprinkle them throughout and ask Ryan some of these questions as we go toward the end of this discussion. But one of these questions that I have here from Jeff is, do you think of climate risk as its own risk type, or is it a driver that is impacting other risks, credit, operational, et cetera? What's your thought about that?
Yes, so it's interesting because we're thinking about it as a framework issue. We know that we are going to stand up some very dedicated resources because you need some very specialized knowledge here. But climate risk impacts and manifests itself through all of our other risk-taking activity. So we might feel it in credit risk outcomes. Depending upon what happens, we may see them as operational risks if the operations are disrupted because of a climate event. That will manifest itself it could well manifest itself in an operational risk. And I think of it as being an adjunct to, just like many of our operational risks can manifest themselves across other risk types. If wire systems go down, we may end up with a liquidity problem, but it's not because we don't have liquidity. It's because the ability to move the money around didn't survive some sort of challenge with the infrastructure. So I think while we are going to dedicate specific resources to it to get a lot smarter about it, this is heavily interconnected with all of our other risk types. And I think there is a risk to use the word, if we isolate it as simply its own thing, then I think we're missing part of the equation, the fact that it actually permeates all the risks that we take across the organization. So I think we have to integrate it. I think we have to have a holistic view. But before we can do that, we have to get very specifically smart about it. And I think most financial services firms are building their capabilities in this area because it's just not an area that we have focused on as much as some of our other risks.
Yeah, no, that's a great point on that one, and it reminds me that organizations are functionally set up, in specialized risk domains, if you will. So you might have consumer credit over here, and market risk over there, and operational risk of all flavors and stripes over there. And yet at the same time, it's trying to kind of put that glue together. That is probably one of the most difficult things for best practice organizations to do. And at the end of the day, that's essentially what you're talking about, is being able to kind of stitch together the knowledge of each of those risks in a manner that brings them together so that you can look at them in totality. That's a huge challenge for any organization these days. One of the questions, and again, I want to bring this back to kind of like the board view. And we've been talking about a wide range of very different risks with very different sort of expectations of how much a board member should know about these risks. So if you're a board member of a risk committee out there of a major financial services company, and you're speaking with somebody like yourself as a CRO and maybe other industry or experts that are coming at the table that day, how does a board member wrap their head around some of these things and to be able to meet their fiduciary responsibilities of asking the right questions, of these people?
Look, I think it's a delicate balance. I think as a management team, we have the obligation to raise these topics and raise these subjects and provide our best insights at a plain spoken way to talk to people about what some of these issues means in terms of risks. I don't expect my board members to be modelers. I don't expect them to be quants, although we have capable folks on our boards of a number of companies that I work with who are capable of doing some of these things. But we have very diverse boards bringing lots of perspectives to these issues. And in some respects, I think our job as a management team is to bring these risks front and center, engage in dialogue, our board members always ask provocative questions, and where they need more information and where they want to go deeper, they make those desires, really clear. And we go deeper and we bring more enlightenment to them to the best of our ability. And in some cases, that ends with, we don't know the answer. So there are a whole bunch of things about climate risk that are interesting and provocative to talk about, but we may not know the answers. But I think what we are obligated to do is bring an array of possibilities and have those discussions. And as I was saying earlier, we have to get to a point where imagine what could happen, how these things could impact us. And then this is where sort of strategic discussions start to come into play, is you think about these array of risks and our intention to prosecute our business and our business strategies. And with the benefit of understanding some of these risks, our boards can think about our business strategy and make sure that they're very clear that some of these risks are going to be coming at us in pursuit of our strategy. And you can either accept that, or you can refine the strategy to try and avoid some of these risks or accept them. Or it may enlighten you as to how much capital or liquidity or preventative measures we think it's important to take if these risks exist and we can avoid them in pursuit of our strategy. I think our obligation is to create transparency around these issues at a level that is plain spoken and that allows the dialogue to go wherever the dialogue wants to go. I'm sometimes surprised at the level of granularity and the detail and the robust interest that we have on boards where I've worked in certain areas across the risk spectrum. And I applaud that, because I think as a management team, we're able to go as deep as people would like, but our obligation is to provoke those discussions and create that transparency to allow people to challenge some of our assumptions, to ask us how bad could it get, because that's what we're there to deliver. We're there to create the information and the transparency to help inform the board's decisions around strategy, risk acceptance, risk appetite. You can't very well set your appetite for risk if you don't have a good understanding of what the arrays of risks are that are out there that you may be facing in pursuit of your strategy.
Yeah, no, that absolutely. And, I'm reminded one of the best practices that was implemented, long after the crisis for some on systemically important financial institutions were, heightened expectations if you're a commercial bank, but the idea being that there'd be executive sessions of board risk committees. I used to joke, golly, maybe I stopped being a CRO too early when they, I never enjoyed having an executive session with the board. But I guess how are those sessions used at companies to better inform boards? I mean, and you might want to tell, there are probably some in the audience here that really don't know what an executive session of the board really means. If you can kind of give a broad brush strokes of kind of what that is and sort of what do you get out of it? What does the board get out of it? That sort of thing.
Sure. I think at its simplest state, it is time carved out for board members, non-management board members and non-management board members only, to meet with the chief risk officer and have a dialogue, sometimes prompted or provoked by the chief risk officer in terms of there may be an agenda, a set of things that we want to get on the table. But it's a, for lack of a better word, a safe space where the board can interact with the CRO and the CRO only. And I think its origins in part were to create a space where the chief risk officer can, without worrying that other members of management are watching or listening, could, if they felt the need, say to board members, I'm really worried about X or Y. I didn't really get a chance to say it, and not everybody agrees with me on the management team, but I really think you should be concerned about X or Y. And X or Y could be people, it could be the pursuit of a strategy, it could be how we're executing things. And I think, there was a legacy before the financial crisis that maybe boards weren't hearing the whole truth, if you will. And so I think in part, this space was carved out to make sure that there was never going to be an excuse that risk managers didn't have direct and exclusive access to the board to share with them what's on their mind in a way that didn't potentially threaten their career or that there would be retribution. Now, I've never worked at an institution where I felt that was either necessary or where I would share anything with the board in an executive session that I wouldn't share with the board in a broader session with the rest of the management team. And maybe I've just been fortunate, but I haven't necessarily had to avail that safe space for that reason. The other advantage, though, of having that safe space is it creates a casual atmosphere for board members and the risk manager to have a dialogue about risks without the worry. I never bring charts or graphs or reams of detail. These are conversations about what's on your mind. What should we be thinking about? What should we be doing differently? And likewise, it's a two-way street, because board members can say, what I'd really like you to focus on? Could you dive deeper into this? And again, they can offer up areas where they're concerned about. And look, I think some risk organizations may not have the resources they feel they need to execute their responsibility. It also creates an opportunity for that kind of dialogue to happen. But I think the more degrees of comfort a board and a chief risk officer can have with each other, for people to pick up the phone, have a good conversation, and share what's on their mind, that only serves the institutions well. And I think this space was designed to help foster those kinds of conversations. And in a perfect world, you actually don't need that space, because those relationships exist and that dialogue can happen all the time. But I think it's a best practice. It's good to have it, and those conversations can be helpful for both sides of the equation.
Having been the unfortunate recipient of working for 3 companies where I wish there had been an executive session, I can certainly paint the other side of why it's so important these days. The lack of air cover, I call it. So yeah, I think that good risk culture, good risk governance, whatever you want to say, would actually have that in place, irregardless of it being forced upon them through regulation. I think, to your earlier point, that the conversations between risk executives and other executives within the organization, and then also with boards themselves, that dynamic doesn't need regulation to tell them you have to have an executive committee, an executive session, that is, to kind of have that conversation. And yet there were companies back prior to all of that, leading up to the last crisis, that failed to recognize that as being an important vehicle or forum for that risk executive to communicate outward. So I think it's vastly important, and I'm glad to see that everybody's taking advantage of that. I've got a great question here from Mark. I'm going to just kind of read this one to you, Ryan. First of all, congrats on the new appointment at Westpac. He says, how do you think about the integration of cryptocurrency trading into the global institutional financial system buy and sell side without having any hard assets behind each currency and without the appropriate regulatory framework to KYC, know your customer? Institutional adoption has started of late, and it seems like a major systemic risk to the entire global marketplace. What say you?
I think the activity is fraught with risk. We've already seen numerous instances of operational challenges in the crypto space, things going missing, accounts being cleared out. It's not a proportionately large part of the overall crypto space. Much of that space actually seems to function just fine. Not entirely clear whether that's lucky or because it's as well controlled as it will be. This is a relatively new space, and for a new space, there are significant flows of value through it. Obviously, there's nothing specific about crypto or blockchain that prevents anti-money laundering and know your customer. In fact, it is a highly traceable activity. We haven't necessarily chosen to put the kinds of safeguards and requirements in crypto providers that we do with banks. But it's certainly possible to do. And I think that's why a great deal of the folks who are part of the infrastructure of this space are actually seeking to have clear rules and standards in the space, because I think there are a lot of players who want this to be part of the sanctioned, universe of trading and money flows for lots of good reasons. But without some sort of consistent standards and expectations, then whatever is the weakest link somewhere by someone, either a poorly intended or poorly operated player, can embarrass the overall system and potentially wreak havoc. And I don't think any of the major players in this space want their instruments, right, to be brought down or questioned because of the actions of some bad actor or poorly organized, actor who has an operational failure. But the fact that these are not backed currencies, and the volatility associated with the currencies, one of the things I look at is how much leverage is actually engaged in the crypto space. And it seems to me that the combination of volatility in value and the ability to gain leverage in the space certainly can potentially harm traders, consumers, people who are taking a view. And to date, it has generated tremendous wealth for some people because we've had generally rising values across the crypto space. But in any short days or weeks period of time, when the volatility sends the direction of those values the other way, there are inevitably going to be people who, because of leverage, get their positions wiped out. And if people are playing with a very small fraction of their net worth, that might be okay. But if companies or individuals are putting too much leverage on these trades in too large a position, I think that's going to have some consumer, some bad consumer outcomes. And I definitely worry about that. I worry that people have the transparency and understanding of what happens. As I said, we have to imagine what could go right and what could go wrong. When people are taking positions and making trades, sophisticated traders I'm less worried about, but the less sophisticated traders, are they doing so understanding that, in a matter of a couple of hours, their positions could be wiped out given the volatility in the underlying instruments. And that's going to be an area where ultimately I think the most responsible financial institutions are going to try and do the right thing for disclosures to certainly at the consumer level.
Absolutely. Switching gears just a little bit, I'm going to try to get a couple of these other questions in before our time is up here. But is the Great Resignation and the loss of talent one of the risks that you're evaluating, and are you discussing it with the board today?
Yeah, so one of the things that's high on our mind, and we've actually not only built out our risk framework, but we've stepped up a lot of our discussions, is talking about people risk as a risk, and how that intersects with the changes in people's work-life balance, their where they work, and whether they choose to work. You know, we've seen the Great Resignation has driven attrition rates up higher, certainly across financial services, and in some pockets of financial services even more. That's been a combination of COVID. That's been a combination of lots of fintech and DeFi operations out there, creating opportunities for people that didn't exist before. And so people have a choice of where they work and who they work for. And some folks are exercising, you know, their ability to choose. And we think about it from a risk standpoint, because we need good people in chairs to get their jobs done every day. And if they don't, the risk is that something important doesn't get done. And it opens us up primarily to an operational risk, but long-term, it's a strategic risk, because if we can't get the right people and their brain power and their activity working towards our strategic goals, we're going to miss those strategic goals. We think a lot about that. We think about people come to work for a whole variety of reasons, including the size of the paycheck, but not just the size of the paycheck. And we are thinking, and our board is thinking about, how do you create the most attractive atmosphere you can to attract people to your value proposition. And I think every institution has to face that, and they will land in different spots. There are some institutions for whom their ability to offer equity in a high growth, high risk company is going to attract a certain amount of talent who are interested in that as being a priority. And other institutions are going to be focused on creating a really good place to work that is trying to deliver good things to their community. And they will make trade-offs in terms of their entire package of attractive options to their workforce. COVID was a catalyst and was also surrounded by a lot of other developments in employment markets. And I think right now we're going through an unsettled period as we try and hit kind of a new equilibrium. And that equilibrium may end up with a much more transactional workforce, and where we all experience higher rates of attrition than we've typically been used to. And if that becomes the new normal, we all will just adjust to it. My guess is we're going through something of an aberration now, and it will settle down, but it may not settle down to the same world that we saw before, and we'll all adjust accordingly.
Well said. I'm mindful of the time, got a few minutes here left. I want to throw this one out at you because I just in the nature of kind of like the training for the new crop of risk managers yet to come. You've been in this business a long time. You've hired many people over your career. Could you talk a little bit about what it takes to be a really good risk manager and have a long career in this space? What does that look like? What are those attributes that you look for in somebody that is going to do good in this profession of ours?
I always look for people who are intellectually curious, who are aware of what they don't know and want to know more. Because I think the world of risk includes so many things. None of us can be an expert in any of it, but being just a little bit curious is what forces you to do the other thing that I like to see in people, is to be unafraid to ask questions. And once you ask the questions, I mean, there's a risk associated with that, because if everybody else in the room knows the answer to the question, you can feel like a bit of an idiot. But at the end of the day, by asking the question, you provoke a discussion and you start to create some transparency. And then finally, we aren't in a risk-free world. And in order to pursue most of our strategic objectives, we have to be in the mindset of taking risk. And so we can't just have people in this space who are looking for the downside associated with everything and wanting to conclude, well, hey, let's not do it. You've got to have people who are curious to understand what the array of risks are, and then move to questions around which of those risks can we accept, which of those risks can we avoid, and which of those risks are we going to get paid for and are aligned with our strategic objectives, and therefore they're risks that we're willing to take. And so I think if people are intellectually curious, unafraid to lean in and learn more and rely on others. As I said, I'm not a quant. There's a ton of things I can't do, and I have to rely on other people to help inform me and to provoke me. And then eventually you're going to be sitting in a chair where you have to make a call. You've got to make a decision. And generally you don't get to make a decision around the risk-free route. So you've got to be comfortable that you're not going to be right all the time. This is about being more right than wrong, and to avoid catastrophic outcomes. And sometimes you make a call, it turns out not to be right, and you've got to face the music on that. And that's why we have things like risk appetites and limits to give you guideposts to make sure that whether you're right or wrong, you need it to be sort of in the fairway on the decisions that you're making.
It really is not an easy job, right? It's trying to call the balls and strikes as you see them, but it definitely is not an easy exercise, particularly when there's so many dynamics around you. Ryan, we could probably go on for another hour. I know you've got other places to be, as does our audience. So I think at this point, I will thank you profusely from the bottom of my heart for being here today. I know you've got a lot going on with your plate and what's going on in your new role. Best of luck to you in that, and all the best. And thank you again, Rob, Nima, for helping us host another one of these webinars, and to the audience for participating. And we'll be doing these on a quarterly basis. You'll be hearing from us fairly soon on the next iteration of this. So have a great day, and thank all of you for attending today.
Thank you, Cliff and Ryan. Take care.
Take
Bye-bye.
care.